Hey everyone, this is Kyle from Notional Finance, and you're listening to the Notable Builders podcast. There are more DeFi projects than ever to keep up with, so we're going behind the scenes to chat with the real builders, the people driving innovation, bringing in new users, and creating real value for the entire ecosystem. On this episode, we talked with Evgeny Gokhberg, managing partner of Re7 Capital. We discussed the opportunities Re7 is finding via their research-centric approach of large-scale strategic liquidity providing in DeFi. We talk about the opportunities and challenges of bringing institutional users into DeFi, as well as managing risk when yield farming at scale. Enjoy. Welcome, everybody. This is the second episode of our conversations with other interesting folks in the space and other builders and other protocols. Today, we've got Teddy from Notional. You got myself, Kyle. I'm head of marketing here at Notional. And we've got Evgeny from Re7 Capital. The goal of these conversations is just to find out a little bit more about what's going on in the DeFi space, hear some interesting perspectives, and expand our vision of what's going on. So, why don't you go ahead and introduce yourself?
Hey guys, thanks so much for having me. It's a pleasure to be here. My name is Evgeny. I am a managing partner at Re7 Capital. We're basically a liquidity fund. So we work with DeFi teams, we study the products, we study the code, and then we provide liquidity to support their growth.
Awesome. And Teddy?
Sure. So I'm Teddy. I'm a co-founder of Notional, and we are a fixed rate lending and borrowing protocol on Ethereum.
Cool. Evgeny, well, why don't we just start off talking a little bit about your experience in traditional finance and how you found your way into the DeFi world?
Yeah, of course. I spent about 10 years in TradFi, in a hedge fund, and then in wealth management, basically managing people's portfolios, which was sometimes boring, but a very useful experience because it teaches you how to deal with all types of asset classes in finance. And I was educating myself about new things, discovered Ethereum in 2015, and it was a jump into the rabbit hole, which eventually led me to DeFi. And once I kind of saw what was happening, it was just impossible to resist the temptation to rebuild and restructure the whole financial system. So I started playing with the protocols, experimenting with some bots, playing with some data, and then eventually grew the confidence to try and launch something. And last year we launched our fund.
Tell us a little bit about the fund. What is the vision for it? And has that evolved over the year or since you started?
Yeah, the space obviously has changed quite a lot since DeFi summer, and things that were very easy and openly available back then have gradually disappeared. So we started with the idea to just, work, find good teams, work with them as early as possible, and then, be early liquidity providers to them. This has definitely evolved. One of the data points, which is probably the most relevant and representative of the whole space, is, when we launched, we were 100% on Ethereum. And now we operate across 7 different chains. So that complexity obviously changed. And what also happened is we started running a lot of infrastructure, because it's one thing to track a few protocols, but when you're dealing with 100 different projects and 100 different protocols, you need to monitor the data and you need to have real infrastructure to manage the portfolio, to rebalance it, to track data, track yields. And we had to build a lot of tooling because it just doesn't exist yet.
I've got a question for you. So, I think something that I think a lot of people have seen and we've seen definitely is, yields coming down quite a lot in DeFi. And I think that there are some sort of standard DeFi strategies that you can use, but I imagine that those kind of standard strategies aren't really producing the returns on capital that you need to give your LPs. What have you done to try and sort of increase your returns? Now, you talked about sort of like going to other chains. Is that sort of where you found the yield that you need to find?
To a certain extent, yes. So I would say partially it is other chains, but that's obviously not enough, right? Because I would say a year ago, well, not a year, maybe even 9 months ago, it was possible to get substantial yield differential on different chains, but that has matured as well. And now, when Andrea announced his new platform and invited people to farm on Phantom, they got billions of dollars in 3 days. So there's definitely enough capital that's willing to move. So that's kind of a necessary step rather than something that's going to give you the substantial edge. I think where we did get and continue hopefully to get our edge is one, just being there really, really early and being ready to move with confidence, having done some preliminary due diligence. But the second thing, which is the more durable one, is infrastructure. It's like, if you trade on CeFi, the arbitrages you could manually capture, let's say 5 years ago, are gone because you have bots competing on a microsecond, millisecond frequency. So we kind of moved towards the same direction and had to build infrastructure where we have some bots which are running in real time. We run liquidity routers for cross-chain liquidity provisioning. So you have to go deeper and deeper and deeper to try and build something which has, some defensibility, basically.
Now, when you talk about the infrastructure, are you talking about yield optimization, or are you looking for like trading arbitrage opportunities?
It's both. So using Notional here as an example, if we can see that fixed rates are extremely interesting versus what's out there on other platforms or versus variable rates that are available, we'll go and we'll lock it in. And one of the reasons why we're able to even see such opportunities is because over the last more than 12 months now, we've been building data tracking. So we are in real time tracking yields from 50 or 70 platforms by now, if not 100. And we're getting alerts every time something moves or if some signal emerges. So that allows us to just be very quick. And then the second piece are basically the bots, where we can, let's say, do something which could expose us to impermanent loss, but we can hedge it out in an automated way because we're designed to be market neutral. So that helps a lot. So it's a combination of data tracking and therefore very hopefully smart rebalancing as well as some automation.
Yeah. So, that always seemed to me like the way this should be done. Because, I had sort of thought, if I wasn't doing Notional, well, maybe I'd kind of be doing what you're doing, Evgeny. And, but I was always kind of surprised that from what I've seen and conversations I've had, very few people are taking the sort of really systematic approach that you're taking. And I'm curious if that has been your experience as well. Are there other guys that are doing this too, or do you think you're one of the few?
I think if someone is doing it and if they're doing it better than us, they're probably keeping quiet about this. So you kind of never know. But I personally haven't seen anyone really do this, right? I'm sure you have, let's say the Alamidas of this world probably doing this and obviously much more. But when I talk to my friends who are farming it on their own, obviously they don't have the time or the desire to do what we do because it's a full-time job. And it's a full-time job for a team, not just for one person. So why would you invest all this time if all you're doing is potentially increasing your, yield by several percentage points, right? You should just build ape or, do something else. And also, I think that's the representation of this can be seen in the tooling that's available. So we have a lot of amazing tooling right now. It's Nansen, it's Dune, Parsec, but you can't really track those yields and you can't really track that data. So we're talking to these projects where, maybe we'll partner up with someone, but I just don't think it's become institutional where enough people care about being kind of optimal, which gives us kind of a window which we're trying to capture.
Yeah, that makes sense. I've kind of felt something similar. I started to write this little interest rate newsletter and just kind of like a DeFi interest rate commentary. And, kind of the motivating thing for that was just sort of, well, for one, I found there was no place that you could find what the compound recursive lending rate was. That is such a basic DeFi strategy. And I didn't find a single place where like that rate was listed. I think that it just kind of speaks to your point. Yeah, I've just been quite surprised. I would have thought that people would be interested in that to a greater extent than I guess maybe they are.
I was equally surprised when I saw that because I did think that it's a no-brainer to track this because I'm sure there are a lot of people using Excels to just, manually copy-paste some data. The reason why we had to build all this tracking infrastructure is because it didn't exist. We didn't want to do it, but there was no choice. And because this data product doesn't exist in public, what we're seeing is you get insane yield differentials. So the easiest example is Aave. So assuming you take the same level of smart contract risk, you can deploy on Aave across several blockchains, right? You can do it Avalanche, you can do it on Polygon, you can do it on the mainnet, and you can do the same recursive thing with the same tokens, but the yield differential is, it was at some point a 7x differential, which was just bizarre to us. But that speaks to the maturity of the market. And then if most people are busy aping into NFTs or some OM forks, then they don't have the time to increase their yields from 15 to 25 or to 30% or more.
How do you make that assessment as far as how much speed that you're deploying into these projects versus due diligence that you are able to do? Or what does that trade-off look like for you? Because I think for everybody it's different, but obviously you're doing it on a much bigger scale.
Yeah, it's a difficult one, because sometimes when you want to ape, you just want to ape. And in order for someone to be able to do this kind of for a living, at first you have to do it just personally. And you get used to a certain speed, which obviously you have to slow yourself down when you're dealing with external capital. But the process that we have is basically very straightforward, right? We try to speak to the teams to get to know them. We look at the code to understand its complexity and how well it's been audited. And then that defines whether we should go or not go. And then if we're going, we just have to size the position up accordingly. So if it's something that's extremely exciting for whatever reason, but we can't get enough confidence in time, maybe we'll put a small position, right? If it's something that's kind of okayish and we can't get enough confidence, then we'll not do it. So it's very subjective, and it's very hard to write a codified rule, because it's even very hard to define and quantify the risk you're taking, right? Are you taking the risk of a rug pull or of a hack, or it's a new chain or something else? And it becomes very subjective. But we have to believe that if we're working with the teams who are smart and who are honest in their desires and ambitions, then over time we'll be okay, even if once in a while we'll have to take a hit.
I have a question about how do you quantify, and you kind of said that it's very difficult to do this, but if you're looking at a project and it yields 5% over what you might consider the baseline, and maybe your baseline is compound recursive lending, where that's baseline minimal smart contract risk. How do you determine what you think is a reasonable yield premium for the additional smart contract risk of a newer platform?
Yeah, that's a very good question. And that's, for us, that has been very kind of intuition driven. When you just look at the platform and you look at the UX, you can intuitively already form a view. When you go to people's Discords, you read the docs, you form a better view. And when you look at the audit and so on and so forth. And we've now done this, several hundred times. My teammates, who are the ones who actually, do the code reviews, they can within a few hours come up with a reasonable degree of confidence as to whether it's clean, it's understandable, and then we kind of weight it up across a metric system that we have internally, which is we basically treat it as a risk rating system. And here, what is very helpful is, for example, DeFi safety, right? It's a great kind of public good project where you can get risk assessment of different platforms. So we try to think about it in a professional way, and then we say, okay, we treat this platform as AAA, triple B, triple C, and therefore this defines more or less where the spread should be. But the magnitude of the spreads is obviously kind of intuitively calculated.
Right, that makes sense. I think that's about as good as you could hope to do, right?
Pretty much.
Yeah, thank you.
Maybe shifting just a little bit, I think it's kind of interesting. One of the narratives we're seeing a lot in DeFi now is there's a lot more focus on revenue models for tokens and projects and how the token holders are going to benefit in the protocol success. Does that change how you're assessing projects when you're going in with capital for providing liquidity, or is that too far down the road in terms of payback?
No, actually, for us, this is an important consideration, because we're not like traditional farmers who would just farm and dump, because we believe that we have a long-term mandate, and we believe that far greater upside can be captured if you kind of back the right team with your liquidity, accumulate a position, and then just sit on it and wait for it to hopefully crystallize some value. So when we see literally a farm emerging, which is a fork of another fork of UniV2 or what have you, and all it does is pumps the tokens, which have no utility and no current or expected value capture, then you just know that it's going to bleed. And then you have to be the first one to be selling, and we don't really want to spend our time doing that. So when you have DeFi is obviously very young, and it's impossible to see what these business models will be for any of the platforms, right? Because it's still going to be work in progress. But, you can form a view by having spoken to the team, read what they write, spending time in the Discords and public kind of AMAs and everything else. And then you can say, okay, maybe the token isn't capturing any value right now, but I can see how it could be capturing it a few months down the line. So we'll just wait. And for us, it's super important because we just don't go into the places where we believe the token is just a kind of liquidity purchasing mechanism, because you end up being break even at best.
I got it. Okay, so maybe we should have gone backwards a little bit and talked about like what the overall strategy of your fund is and what do you consider long term, I guess, as well. You mentioned long term. I know DeFi, that's always subjective as well.
That's very true. I mean, ultimately, we're a fund which is designed to generate yield without taking on the price risk of crypto. Our principal is deployed in stables, which we, diversify and then hedge out. It's deployed into some other market neutral kind of strategies and positions. And we sometimes just earn the fees or just earn some ARB. Sometimes we earn the tokens that we farm, right? And then we try to see them as long as we can. Then it just becomes reactive, right? So there are some tokens which we have not sold since we launched, and there are tokens which we, sell occasionally. So it really depends. And, you kind of have to combine, I guess, like a fixed income style mentality and a long only style mentality, which is a paradox in the space. And, with regards to the long term, it's a great question because it's like people ask, what will DeFi be a couple of years from now? I find it's impossible to answer that because it's only been around for 2 years. So it's a little bit difficult to extrapolate and define what long term actually is.
For sure. I think we all feel that pressure. So I guess looking forward, and you mentioned NFTs earlier. I mean, they're definitely getting a lot of the spotlight right now, taking maybe some of the limelight away from DeFi. But I think it's really interesting to think about like how NFTs and DeFi might converge in the future in interesting ways. Or do you see any interesting trends in NFTs that you guys are looking at, or is that just like besides just JPEGs, is there something within NFTs that you're looking at?
Yeah, I actually think that NFTs are a real blessing for DeFi, because when I was launching the fund and I was trying to get people from the traditional world to kind of buy into the vision of DeFi, they were asking me, what's the point of this? Who's benefiting apart from speculators and lenders and borrowers? And I was telling them that eventually, some digital economy will truly emerge, and then finance will just be supporting it. So now that we have NFTs, and clearly NFTs can be very, very huge, and they could be, even like I was looking at some data today, since the market crash, the market peaked in like late November or mid-November, and some of the DeFi dApps slow down, but traction in NFTs is actually just a parabolic growth. So hopefully this is real adoption and, on the way towards becoming mainstream, and then DeFi will support it, right? So we already are, we're talking to some people to potentially lend against their punks or apes. And we have a machine learning expert who are running some numbers and building a neural network to see if we can price NFTs against each other. But it's obviously very tricky because it's they're standardized but unique and really not very liquid. So there will definitely be some use cases because, if you have traditional art, traditional IP, and other kind of soft assets, there is obviously a financial industry servicing them, but we're still yet to see how it's going to play out. But I think something definitely will emerge. On that note, I'm curious how you guys think about it, because I assume you must have at least 25 times or 100 times thought that potentially a lending protocol could support NFTs with all the complexities around it. So I'm curious what your conclusions are.
So I mean, it's not something that we've looked into a ton yet, but I think it definitely makes sense at some point. Because I agree with you that I think ultimately, because it's something I've thought about DeFi as well, is there's the criticism that it's entirely speculation driven and it's circular, and does it really do anything actually valuable? And, I think that there's a fair amount of legitimacy to that critique, but I think that, it's something that I've talked about a little bit before, but I think that the sort of new kind of digital economy, of which NFTs are a really large part, that new economy won't have access to traditional financial services, and it just won't be the right fit. And I think DeFi is going to play the role of a financial system for this new economy. I think that that's really where you're going to see the sort of, quote unquote, legitimate use cases for DeFi. So it's absolutely something that we want to do in the future. I think it's really hard for now, and it's not clear Yeah, it's just it's really not clear, because it's like, if you're going to take something like a CryptoPunk as collateral, it's tough to do it in the same way as Notional's current collateralization framework, right? Because it's just, you can't be sure that somebody's going to be at the ready to buy it. Ultimately, it's going to make sense in some form. We just haven't really figured it out yet.
Yeah, it's definitely a tricky one, but an interesting one.
So, I mean, we talked a little bit about the NFTs, bringing in the wave of retail users and its new user class. What do you think about the whole narrative that, the institutional money is going to bring this, another wave of users into DeFi, or maybe it's already started, or how do you actually see that playing out? I mean, do you have any institutional investment in your fund, or what do you think is happening in the short term?
I think we're obviously seeing some institutional wave of capital coming in, but it's obviously coming in as, investors, right? So when we see this, these gigantic rounds of whether infrastructure providers or, Consensus or Polygon or whatever the latest announcements are, because there's 5 a week. You already have some large investment banks and, very large funds participating. And even if we take Circle, the ones who are behind USDC, I mean, they're backed by Goldman. So there's definitely something like that happening. What is not happening is the actual usage, right? So it's not clear why one mutual fund would go on the blockchain to interact with their TradFi world counterparties. So there are definitely people that are starting to dabble with DeFi, but it's very experimental. An interesting one I saw a few months ago was SocGen, who announced they want to do some sort of a mortgage bond and put it inside Maker, right, to kind of bring the real world assets into DeFi, which is in line with what some projects are obviously doing in the space. I honestly think that before the real old boring kind of TradFi institutions come in as users and not just, the backers of some of the larger projects, by that time NFT will grow, as an industry will grow 100x and DeFi will grow on its own to support it. Having spent over a decade in those institutions, it's a little bit tricky to see how they can suddenly change their mind, because when I was setting up this, this DeFi fund, my old colleagues were, I was explaining to my colleagues what I would be doing, and they basically asked me, so it's a Bitcoin fund. And I would try to explain to them again, and they said, well, basically it's Bitcoin. So I said, yeah, sure, it's Bitcoin. And I don't think it's going to change very quickly. But maybe it doesn't need to, because the financial industry around crypto is already gigantic. So we don't really need those large banks for a long period of time.
Yeah. How about you, Teddy? How about your old colleagues at Barclays? Any converts?
Nah, yeah. I feel kind of the same, Evgeny. I mean, I think my feeling is that, the quote unquote institutional capital coming into DeFi, you've seen a lot of it come in through the sort of venture funds, because everybody wants the crazy venture returns. I think that what's more likely, because we've had a couple, I don't know if you'd call them institutions, but family office type people use Notional, right? So directly using Notional. But I think realistically, a more realistic on-ramp for that kind of capital is just to come in as LPs in a fund like yours. That's what makes more sense to me. Rather than using the protocols directly, they invest in you and you use the protocols on their behalf. I feel like that's what makes more sense.
That's definitely what we've experienced with our investors, because by the time you explain to someone what DeFi is, you already lost them. I don't know, about you guys, but it took me over a year to understand the principles of Ethereum, just at least at the basic level. And then, when DeFi started, it wasn't very clear how to approach it, and it was lots of trial and error, basically. So if you're someone who has never done this, why would you suddenly understand this very quickly? And they get very fatigued, and they don't want to run the wallets and deal with all that stuff. So I think for a long time we'll have kind of funds in the middle facilitating the capital deployment into DeFi. So what we've seen definitely resonates with what you're saying, Teddy.
Yeah, it makes sense.
Before we sort of turn the tables and let you ask any questions, and we also want to take some questions from the audience, maybe just going backwards a little bit, you talked about, you used to just be on Ethereum, and now you're looking at lots of projects on other chains. Do you want to drop a little alpha and tell us like where you see a lot of the momentum at the moment and good yields coming in?
Oh, that's a good question. I ask myself this every day. I think if we spoke a few weeks ago, it would definitely be Phantom. Now, obviously, the ones to watch are, StartNet and everything around, ZKs. That's where everything is headed. We're still doing our research, learning how it all works. As it's probably going to be an alpha, but as speaking from experience, when you look at other L2s right now or other L1s, it is quite rare that, let's say, to use, Teddy's terminology, you have like the risk-free yield or a base yield, right? So you have a certain base yield, let's say on mainnet, and you see that some other L1, there's something that's popping up, which you believe is real, and you want to move there. In our experience, it's quite rare for that yield differential to exist for a very long time. So what we're seeing ourselves doing, and this is now becoming a painful pattern, that we would be moving from mainnet to somewhere else, and then a few weeks later we have to go back because that opportunity was temporary. So I think people are starting to be a little bit dismissive of mainnet, and that's probably a mistake.
I mean, I think that makes sense to us. We're definitely bullish long term on Ethereum. All right. Well, if anyone in the audience has questions as well at any time, please feel free to raise your hand and we'll get you in there. But Evgeny, if you have anything you want to bring up as well with Teddy.
Yeah, I'm very. When I was in traditional finance, I haven't really done much like interest rate derivatives, so I kind of understand the principles, but not the complex details. And what I'm curious is your vision about fixed rates in the space, and it's very clear why you need them, but who do you think needs them the most right now? And for whom would this be like a killer app as the space matures?
That's a good question. I think we've seen a lot of use from so on the lending side, I think that kind of, people that want access to the DeFi rates, but like really don't want to, because, actually getting like the really good rates of return in DeFi, it requires a lot of you have to do a lot of stuff, like essentially all the stuff that you have to do, Evgeny. I think that we've seen a lot of interest. So from these, kind of these high net worth individuals to utilize Notional just because the rate is fixed. So it's just simple. Right. And it just gives them something that they know what their return is going to be, and it's not going to change over some period of time, and it's certain and it's easy. So I think from the lender's perspective, it's really a pretty simple value proposition, and that has been very valuable to people so far. Now, I think going forward, something I'm excited about is it's kind of like a development that is further down the road for Notional, but we're sort of speccing out right now. But what we're going to do is allow people to borrow fixed on Notional. And again, this is right now it's in the idea stage, but it is a development that's coming further down the road. We're going to allow people to borrow fixed on Notional for a term of say 3 months or something, and then use that cash to directly partake in a trading strategy. So like in a yield strategy, for example, doing the recursive lending strategy on Compound. So you'll be able to borrow from Notional to a smart contract that executes that exact strategy, right, over a 3-month time frame. So essentially then that gives you really, really high leverage exposure to the returns to that strategy. It's almost like that product is like a total return swap for a specific yield strategy. So I think that that's really cool. And that's something that you need a fixed rate to do, because it allows you to sort of
lock in the cost of capital.
Yeah, exactly. And I think that that's going to be a really killer thing. And it's something that Notional, the company, is going to use with its own balance sheet for sure. And I think it would be the sort of thing that you guys would probably be pretty interested to.
Yes. Yeah, definitely. Yeah, definitely count us in.
Yeah, so I think that's cool. And then, I think that's kind of in the near term, just because I think ultimately, where you're seeing the demand for borrowing on Notional today, it's still and this is in crypto just generally. The primary use for people borrowing against their crypto is to, either go levered long or execute yield strategies, trading strategies, that kind of thing, right? That is just the truth. It's been that way for a long time now, and I think it is still that way. And so this sort of development upgrade that I spoke about is going to allow you to do that with sort of maximal efficiency, which is really cool. But, further down the road, kind of as you're talking about, Evgeny, with the sort of growth of this, nascent digital economy that just doesn't really exist yet, I think that fixed rates are going to have a huge part in that sort of new economy, but it's, realistically, it's not there yet.
Yeah, it makes a lot of sense.
All right, let's get someone from the audience here at the video. Let's see, I got you muted, but I think I can get you on here.
Wonderful. First of all, good afternoon, everyone. I have two general questions to ask. Number one, what is your expectation for the fixed rate percentage throughout 2022? And the second question is, what are the key elements affecting these fixed rates, such as politics, FED decisions, bank rates, etc.?
All right, I can take a stab at sort of the fixed rates on notional. So I think right now, fixed rates on notional are kind of 8 to 9% on stablecoins. And those rates have been kind of consistently coming down over the last few months as we've just seen a lot more lending. I think that those rates are going to continue to go down. My general framework for this is I think, and I'd actually be curious to hear what you think about this, Evgeny. But I sort of think about the base rate as being that sort of recursive lending rate on Compound and Aave. And right now that's about 5.5%, 6%. And so the fixed rates on notional are maybe 3 to 4 percentage points above the sort of base recursive lending rate. And I expect that margin to compress.
Is everyone on mute or something?
Excuse me? I would expect the sort of spread between the recursive lending rate and notional's fixed rates to compress a little bit. But I think that notional's rates will remain higher than the baseline recursive lending rate. So I would expect notional's rates to come down to maybe 6 or 7%. I think that's sort of where I think they'll end up over the next couple months.
Yeah, I definitely agree about how to think about the risk-free rate in the space. I guess with the only caveat that that risk-free rate only applies to people with capital, because you need to burn a lot of whether it's Compound or Aave on mainnet, and I do think mainnet should remain the benchmark. It is really expensive to do that recursive thing with gas, and then what's also important to keep in mind is, especially if you talk about Compound, then all of your yield really comes from the liquidity rewards. So you're exposed to a volatile token, which hopefully, in line with the whole DeFi market, will rally one day. But so far, it's been difficult, and you need to pay costs to claim and to sell if you want to truly lock in a fixed rate. So that's why I think it makes sense for there to be more demand for platforms where you get clean yield, so to speak. But at the same time, it can't stay can't stay higher for too much longer, because then people like myself will basically arbitrage it away and keep aping into notional.
Great. I would just say the second question I think was kind of about sort of in real world events affecting rates. I guess it's hard to speak to because it's a global DeFi market and lots of individual things happening in different places. But
I can start on this one. The short answer is that it's really difficult, and I think it's pretty much impossible to answer this question properly. But if we just take the examples of the last couple of months, so far there's been a reverse dynamic on the yields, right? So normally what would happen, right, in the real world, you would expect the rates go up, or the inflation goes up, or the expectations of rates going up go up, and then your yield goes up, which is what happened in the traditional world, right? So high yield bonds, for example, they sold off, and then people who were sitting in them kind of lost money, but the yield right now is higher. If we are talking about DeFi and crypto, then it's been very, very, very different mechanics, because the yield comes from a very different source, at least on average. On average, your real yield comes from liquidity rewards, and in line with the S&P and Nasdaq going down, crypto went down, so your yield actually went down. But what actually happened is you're not a single stable coin, because we track basically all of them. Not a single legitimate one crashed or even depegged. You can argue that meme went through some turbulent times, but actually did really well, and it wasn't macro related. So what I think you have is even a different microstructure of asset classes. So whilst, let's say, your yield on, let's say, stable coins goes down, they're actually not losing value, at least in notional terms, unlike bonds, because bonds are actually going down while yields are going up. So there are a lot of counterintuitive dynamics here. Personally, I'm a little bit cautious on the markets because, I think it would be too easy if after so much money printing and such high inflation, a small correction for a couple of months and then we're over. So I think there is probably more pain to come. But, we don't really care because we're going to stay in this market, hopefully for the rest of our careers. But that's how I basically would answer this question. I know, Teddy, what do you think?
Yeah, I think it's going to be tricky. I suppose, I think DeFi rates are going to continue to go down is sort of my expectation. Because kind of as you said, Evgeny, there's a fair amount of capital in the space right now. And the primary source for these yields generally, now this isn't true on Notional, but most of the space, the primary sort of generative source for yield is token prices, token incentives. If I had to guess, I'd say that inflation just printed really high. We're going to see an unwinding of sort of like recent Fed policy. That's just going to hurt. Yeah. I just don't see any way that doesn't hurt. And then you've just got all this capital in DeFi. And I think once it's in DeFi, I don't really think it's just going to leave. Because I think it's like if the capital's come into DeFi and it's willing to take DeFi risk, it's gotten comfortable with that. So I think that's going to stay. And then you've just like one of the main sources of that yield has just not producing so much anymore, right? So mm-hmm. I just feel like my guess is that yields are going to sort of continue to come down. That would be my guess. And especially just like, because you just think about the risk of the space goes down as well. That would be my guess. Yeah.
I think maybe if we don't have anything else from the audience, I think we've taken a lot of your time, Evgeny, and we want to thank you very much for joining us today. I did want to make one other comment. I saw on your website you're hiring. Do you want to just tell us a little bit about the positions that you're looking for, or it sounds like it'd be a pretty cool team. Pretty cool. Obviously, everyone is interested in what you guys are doing in the space.
Thank you. Yeah, shilling is we need shilling for sure. So we're growing. We need more analysts to help us, dive deeply into DeFi projects and help us understand them. We need data engineers who can help us track even more platforms, connect to different chains, to different projects and get the data, as well as quants who are kind of working to, to automate more things. So basically, for anyone who's been in DeFi for more than, a few months and is interested, then it could be an interesting fit.
All right. Sounds good. Well, I'll try to get the word out, and we'll post this whole conversation up on YouTube in the next few days. And if anyone wants to reach out to you, obviously, you can do so on Twitter, I assume. And
of course.
Yeah. Excellent. Well, thanks again for your time. Really appreciate your insights. And come back and talk to us again sometime.
Yeah, with pleasure. Thanks a lot for having me. And congrats on everything you've built, and good luck for the future. Thanks, guys.
Bye. Thanks, everyone.
Bye-bye. Bye-bye.